Welcome, fellow business brokers. Thank you for joining today. So back on May 9th, the SBA came out with a memo, and they were talking about new rules and regulations that they're going to be starting as of August 1st, 2023. Well, today is July 28th. We're a couple days before the August 1st. Now, when they first put out that memo, there was a lot of changes. And since then, there's been some modifications to those changes on the SBA's part. And at the same time, the lenders have had an opportunity to digest that information and see how they're going to respond to those changes. So remember, the SBA sets their minimum guidelines that have to be followed in order to get an SBA loan, but obviously the banks can build things on top of that. And that's what we're going to be talking about today. And obviously a lot of these changes that you guys have been hearing about have been fantastic on the surface. It's really good. It's going to hopefully spike SBA lending, but there may be some drawbacks to that as well. So it may not be as good as you think it is, but there are some positive things in SBA. We'll get to that at the end of the program. At first, I want to introduce our three wonderful SBA lenders and brokers that we have with us today. I respect all three of these people. They're fantastic at what they do. That's why I invited them today. Steve Mariani, thank you for joining us today. How are you doing today, buddy?
I'm doing great, Jim. Thanks for having me. This is real important. I am so happy to be with my other esteemed guests and be able to get some of this information out there and just stop all the craziness that's going on, or at least a portion of it anyway. So
Steve,
thanks for having us.
I don't know. My head has been spinning. I'm so glad to have you on again, Steve. Fantastic. Lynn Singletary, wonderful to have you on. Welcome to the show.
I'm glad to be here. I'm looking forward to a great conversation.
Yep, we're gonna have a lot to talk about today. That's for sure. And Tammy Teese, how are you doing today?
I'm good, Jim. How are you?
I'm doing great. Thank you for joining us.
My pleasure.
Guys, first thing, let's just jump in. I think one of the most, I've been doing this for a long time, selling businesses for almost 25 years. And the thing that stood out to me the most when these changes came out was the thing about the partial change of ownership. So maybe we can touch on that at first. Tammy, would you like to start and talk about that new change with the SBA?
Yeah, sure. Absolutely. First, I just want to say these are all sort of moving targets, and everybody is really just trying to interpret everything, and there's going to be additional guidance. So, everything with a grain of salt. We're all still learning, and rules are still changing. So,
let me just say this. Before you go on, I totally agree. You remember when we got hit with COVID and and the SBA came out with all those rules, and we were doing webinars, and it was like we would talk about something, and then two weeks later we would have another webinar with updates, and we're kind of seeing the same thing, right?
Yeah, really, because it's a moving target. Everything is changing. They're always revising. And so that's kind of the stage that we're in right now. They came out with this really great, what we thought was a really great new rule around partial change of ownership, which would allow somebody to do a buy into a company, which in the past was not the case. It had to be 100% change of ownership. So, the seller would be allowed to stay on, own a certain percentage of the business, and stay on for more than the 12 months, which previously they would have to leave after that 12 months. And so it was thought originally that if that were the case, if the seller only retained, say, 15% ownership, that they wouldn't have to guarantee on the buyer's loan, which would make sense, because why would they want to guarantee on somebody else's loan? Well, they're going to be making some changes to that. And if the seller, any one of the sellers, owned 20% or more of the company within the last 6 months, they will have to guarantee, and we believe at this time they will also have to pledge personal collateral. So that's a tough one to swallow. We thought it was a really good thing at first, but it sounds like it may be more of a challenge going forward. Now, there may be certain situations where a seller is selling 90% and he had a partner at 10% and they have always owned 10%, and maybe it's not going to be that much of an issue in that scenario because they've never owned 20% or more. But we're still looking for some clarification from the SBA on that. But there is still going to be allowed for partial change of ownership. It's just going to be a little bit more sticky than we thought it was going to be. to get those things done.
So if somebody owns 100% of the company, if they owned 100% in the last 6 months, they're going to have to be a guarantor in that. Okay.
That is the way that we are interpreting that. Yes. Mm-hmm.
So the only way that would really work is if there was a minority partner in the company less than 20%, and they wanted to remain as a equity partner in the company or in the entity. That would be the only way it could work out, and the other partners completely sold out.
That's our interpretation. Yes. Mm-hmm.
Yeah.
But what they also have to though realize is not only yes, there is a personal guarantee, but the corporation is going to have to guarantee too. So if even if you're a 15% owner and you're not required to personally guarantee, if you're a seller, you're selling, you're one of the partners that are staying, then the company's still guaranteeing. So
right, they have to be stock purchases. That's correct. Mm-hmm.
Yeah.
Yep. Okay.
So that's one thing too. So it's not as attractive as it was on the surface at first.
Because that was a big
And Jim,
change.
what's really coming? I'm sorry to interrupt. What's really coming into play here is what you guys alluded to is there's a 6-month look back rule. It comes down to the seller's ownership percentage 6 months prior, and that's where it's if they were past 20%, like Lynn mentioned, their collateral may be considered, but their guarantee is a must.
Mm-hmm.
See, that seemed at first perfect for us business brokers because, as you guys know, they just passed that federal law that said that as brokers, we can sell a portion of the company, where before we could only sell 100% if we didn't have an SEC license. So, it's kind of nice that it was kind of matching up, but that's off the table, you guys are saying, right? As of now.
Yeah, we think they're just going to be more challenging. Not much like you just said, not as attractive as they were before.
Okay. Well, I guess there's no really reason to talk about, a seller note when it comes to equity for an SBA loan, right?
Well, there is a little bit of information on that too, but there is an upside to or a possible upside to the partial buyout. I think it was Tammy, I forget who said it, but if you did have a license holder that was less than 20% prior to 6 months, they may be able to help the transaction move forward with your buyer. So we let's just say a partner had 10% and he was the license holder. We may be able to use him moving forward with the new buyer of the other 90%. So that like they were alluding to, we have to look at it on a case-by-case basis, but there could be some good pieces that could help transactions happen, especially on your license type businesses.
Okay. So, we've heard a lot about how a seller, because the buyer needs 10% down to get the SBA loan. They did do a 10% injection. And we've been hearing a lot about that, that 10% can come from the seller in terms of a seller note. Where does that sit right now?
Well, I don't think it's necessarily that whole 10%. So basically the seller can hold basically 3/4 of the borrower's cash injection. So the 10% is still required. Seller can hold a carry note for 3/4 of that 10%. Borrower has to put in 1/4 of it to be valid. That seller note then needs to be, it has to be on, they say full standby for 24 months. However, if there's cash flow in the business that can support interest only, then the lender is allowed to let the note pay out interest only for the first 24 months, and then it can start receiving principal and interest payments. Cannot have a balloon though. So if you've got a 10-year deal, a 10-year amortization, that seller note cannot balloon in 3 or 5 or 7 years. It has to be a full amortization for the 10 years.
The full 10 years. So,
yes.
So let me get this straight. So that 10% that needs down, the injection that needs down, that could 7.5% of that could come from the seller as a seller's note, and then 2.5 from the buyer, according to SBA rules.
Yes.
Yeah, that's as the rules read. I think the challenge there, Jim, might be from the lender's perspective. the leverage from the bank and then from the seller, and the skin in the game from the buyer. So I think those will be one-off situations where it might be a strategic buy or an employee or something like that, if that in fact does stick.
Right.
Or
Yeah,
if,
'cause that's
open
what you
rules.
guys are all experiencing. So that's what I'm hearing from all the lenders is that they're not willing to do. They want some skin in the game from the buyer. I haven't spoken to a lender yet, and I've spoken to a lot of lenders
well,
about there. I
yeah.
haven't spoken to one lender yet that's willing to do that. That's correct. In the real world,
Now,
that's not going to happen unless it's Tammy's
you could have a
situation.
buyer that might have you could have a buyer that might have a lot of equity in outside collateral that is, going to put in the 1/4 in cash, but still may have a lot of equity in outside collateral that may get the lender comfortable, because that would be, in my view, skin in the game. They're pledging other personal assets. That would
Got
be
you.
like a situation that I could see our credit people, jumping on. But just in general, having the buyer put in only that 1/4 of that 10%, it's tough. It's tough for the lenders to stomach.
Right.
And here's really the catch-all phrase that's in all of this information: use prudent lending guidelines. So that was always my other concern. They put that, I can't tell you how many places in all of these new rules. Now, and we can talk about this toward the end, but again, is that putting more responsibility and opening up a little bit more of we can not honor our guarantee concerns, So like I said, throughout the entire rules, they are keep going back to prudent lending guidelines and what you would normally do. So they don't want the lenders to go too far, or they'll again be putting their guarantee might be at jeopardy or in jeopardy.
Yeah.
Okay.
So
And
that's
a lot
why
of
you're probably not seeing we'll do 100% financing all day long.
Well, and a
Yeah.
lot of it too in the new SOP says follow your guidelines that you would do on your conventional deals. Well,
Right.
your conventional deals, you are not even doing 10% down on your conventional deals. So, if you let a borrower put a 1/4 of that 10% in, deal goes bad, they could always come back and say, well, really,
Right.
in your conventional side, you require 20%. Why didn't you require 20%, type of thing. So, and SBA has been known to do that. So,
Yes, they have.
Yeah.
When I first read the rules with the prudent lending guidelines all over, that's the first thing I thought. But I've lived through this before, probably 2 or 3 times. I remember where every single lender in the country was going GP because we were tired of getting our guarantees. But that is the first thing that I thought of when I read all of that, putting the onus on you guys.
I guess it was like everything was like really exciting when it first came out, and it's kind of now that everything's settled, we're seeing the real world practicality of everything is kind of settling in. Yeah. What about straight owner's note? It's not used for an injection. Let's say the buyer's putting 10% down, and they got strong numbers, but they want the buyer or the seller to carry a seller's note. What are we looking at right now for seller's note as far as structure?
I don't think there's any restrictions, and y'all correct me if I'm wrong. If it's not being used for equity and the cash flow supports the payment, they can get paid. It could be a balloon. It could be over the 10, 15 years, whatever they negotiate. And as long as the cash flow supports that debt, then, there's really not a lot of restrictions on a seller note, to my knowledge, that isn't being used for equity.
Is there a standby for principal and interest?
It just has to be able. Yeah. Go ahead.
Yeah. I was just going to say, not if it is not counting toward injection. That's really the bottom line. The restrictions are only, like Tammy said, cash flow related if it isn't going toward cash injection or down payment.
So as long as we're getting the cash flow,
it's up to the lender to decide.
Yeah.
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 And that note can be paid
great.
off anytime too. So there's no restriction on when that note can be paid off. So if the buyer, the borrower buys this business, takes a seller note, not part of the cash injection, and they're rocking and rolling in a year and a half, and they got all this cash and they'd prefer to just get rid of the seller note, they can do that. As long as their SBA note is not delinquent. There's no restrictions on that also.
And then even if don't the seller's notes subordinate to the SBA loan though?
Yes. Yeah.
So
but
do
you
we
can-
need
but they
permission from you to pay off that seller note? Don't we need
Not-
written permission up front before? No?
I don't think so. I don't think so. Now,
wasn't sure.
again, I could be wrong, but I don't think that's the case. I've had some do that. Now, if they want to refinance it with an SBA loan, it's got to be, payments
Right.
have to be made for 24 months,
Mhm.
principal and interest payments. But they can pay it
And
off.
still no earnouts, right?
No earnouts.
But they did lighten up on forgivable notes a bit.
Yes.
From what I was reading. Okay, my forgivable notes have been in question for the 15 years when I created them, and really now that they're saying is if it's to the benefit of the buyer and not to the seller, that which is ridiculous because the lenders that argued with me, SBA hasn't argued with me in any of these years, but there were a few lenders out there, and the Nagel thing that came out last year that the forgivable notes are off the table, and that freaked out all my lenders. But forgivable notes do seem to be more acceptable now, and SBA wrote something about it.
Forgivable seller notes, right? I just want to clarify. So can it be attached to anything, Steve? Just the forgivable seller?
When you
they
talk
don't hit a
about
certain
earnouts,
revenue number or something like that, it can be forgiven.
just like your earnouts, what you're typically thinking about is gross revenues next year or employees or whatever it's going to be tied to. Those milestones can convert right over to a forgivable note with the exact same terms. What the SBA's biggest issue was with earnouts, which is why they're not allowed, is we were excluding them from the valuation and we were excluding them from the down payment calculations, and that's what they were upset about. Which is why I created that forgivable note, which covered both of those areas, which is why we've been able to do that for years. But those were the two big hang-ups.
And Steve, isn't it really the earnout it's kind of a weird thing. People think it's one thing or it's a different thing. And as long as the purchase price is a definitive purchase price, that's it can't be a floating purchase price where the seller is going to additional benefit. Would you agree with that?
Right. Absolutely. It all has to be included up front, which is why when they're doing it off future projections, I need the valuation to support it. And I tell them that up front, right? Earnouts used to be, hey, we're going to do X amount more next year, and I want some of that. No. We're determining that number right up front. And what happens is if we don't hit them, it's forgiven, as opposed to we're paying you extra if we hit it. So, but that's going to help. I am a big fan of those.
So I've got a question for you in that regards then. So, if you're in a situation like that where you have an owner's note, does the owner's note and the SBA loan and the money that the buyer's putting down, does that all have to valuate out on an appraisal, or doesn't it matter?
I'll let one of them young ladies address that.
I think it does have to value out. I mean, but if the appraiser is using the historicals plus the projections, and those numbers are in the projections, then I think theoretically it should value out. I'm not a valuator though, but.
And you saw the
now,
cash
keep
flow.
in mind with the forgivable sale. Sorry, I missed that.
No, go
what
ahead,
I was going to
Steve.
say is with that forgivable note or on that earnout scenario. So there is an SBA rule because that could be tied. As long and here's what the rule says. The rule says is as long as the SBA loan amount is less than the valuation, you can go ahead and close the loan.
Yes.
So if there was a forgivable note, but it was above the valuation and it was above our loan amount, because you got to keep in mind the down payment and seller note are both going to come off of that total project cost. So it comes down to what the SBA actual loan amount is. That's what's got to be tied to the valuation.
Right.
So your forgivable note could be almost an earn out on future revenues if you think about it like that, which is not how we think about it. But
no.
So Steve, you don't think it has the seller note has to be part of the appraisal part? It doesn't have to appraise out at that amount. Let's say a business is selling for two.
As long as my valuation supports my loan amount, Right. And we're going to make the buyer sign off on it. Hey, I understand the valuation came in low, but this is why I am willing to pay this. Then we will go ahead and close the loan.
Okay. All right. Great.
And I think those performance-based notes that you're doing, Steve, I think it's really helping to bridge the gap right now between, the purchase price between the buyers and the sellers, because today it's not, because of interest rates and things like that are playing into it, doesn't mean the business isn't worth, say, $1 million. It just means we can only finance this amount. It doesn't mean your business isn't worth it. It just means this is all we can lend on it. So how do we bridge that gap for the buyer and seller?
Right. Great point.
Tammy, you brought up a good point. And I want to throw this question out to you guys and get your opinion, because I've heard brokers have two different viewpoints. That, with interest rates where they are right now, I mean, they're the highest I've ever seen them in my career. And to me, and I want to hear what you guys honestly think. To me, the value of the business doesn't change because interest rates are higher. But I've heard brokers say, well, the value of the business decreases because the interest rates are so much higher now. Now, I do agree that the buyer's buying power is less, but I don't think the value of the business changes because of what the buyer is able to finance or not be able to finance. What's your guys' opinion on that? And what are you guys hearing from appraisers?
I have to agree with you, because the thing is if you have a cash buyer that comes in and is not getting financed, you're going to pay that price. So in my view, the value has nothing to do with the price. I mean, the value has nothing to do with it. It's just, it is what it is based on the cash flow and the multiples and, and the seller discretionary earnings. Just so happens the buyer has to finance it. Well, then that's where the seller notes come in, more money's, being injected, that kind of thing. But I don't see why it would affect the value. Steve, Tammy?
I agree with Lynn. I've been preaching this for months too. You have to look at, like she pointed out, a cash buyer. It doesn't, because the borrower has to borrow more or less, should not affect the business value. Same thing with his salary. He needs 100,000 versus 50,000. Again, the business value doesn't change. So now, that said, there are different areas and different industries where it's making it more difficult to sell that business. That's something we rely on you to do.
Yeah,
you have to determine if you're not. Yeah, that's changing a little bit, and I do see that adjusting in different parts of the country and at different industries. Where they have to give away a little bit, but that's on you guys, and that's just a normal part of business.
And it's, to me, it's, and I'm surprised that brokers, because I've heard a lot of brokers say that, and I just disagree. And the appraisers that I've talked to, they disagree as well. And Lynn, you brought up a good point about what if it's a cash deal, but also about if in 2 years from now, 3 years from now, the buyer refinances that loan, the interest rates drop, and they refinance that loan. Does then the seller get some of that money back? I mean, I'm being, that's a rhetorical question, but I'm just saying it shouldn't affect the value of the business.
Well, if you sort of think about it in this vein, right? When rates on mortgages were super low, they, 2.75, somebody making $200,000 a year could buy a home for $1.5 million. Today, they cannot do that. It doesn't mean that house isn't worth $1.5 million. It just means that the person can't, their borrowing power has decreased because the rates have changed.
Great. Well, let's get back to the changes on the SBA. I'm sorry I interrupted that, but I thought that was an important thing that we were touching on there.
Good stuff.
So another big thing that I thought was a big change that I saw was this whole thing that the seller could remain past the 12 months as a key employee, correct? Is that still in place? Because it's always been that the seller can't stay in the business past 12 months with an SBA loan. Where does that sit right now?
I believe that is still just a partial change of ownership. If it is 100% change of ownership, they must exit after 12 months. Is that your interpretation as well?
It is mine too. I took a poll I took a poll from lenders recently, just within the last few days, on this question, because it does continue to come up. There's still a lot of controversy, and it's not written in stone as of yet. Okay, so you can't take any of this to the bank, but ultimately, the majority of my lenders are coming back saying we're defaulting to the old 12-month rule. If it's 100% change of ownership, that's what we're going with. We're just not, we're not leaving them there as the seller.
Okay, so that's what the banks are saying. That's what the lenders are saying. What's the SBA saying? And I know that there's like, what the SBA says and then what's really going to happen. But do you think that'll ever play out, or you think we're stuck in a 12-month scenario?
I think they have.
You know what's ironic? 4 or 5 years ago, the SBA beat us all up. Maybe it's 6 or 7 because I could be off by a few, but they said we do not want the seller involved because of the defaults are huge when they're connected. And that's always been their stance. We want the seller out of the business. That's where the 12-month rule came from. That's where the 100% change of ownership. I mean, I've done all the research on that, and that was always their stance. And like I said, 5 or 6 years ago, they said, get the seller out no matter what. Don't let them hold the license. So they've been beating that into our heads for years. And now all of a sudden they're coming out the opposite, saying, we think you can leave them there. Now, what the research showed me, they always wanted that rule in place because of the arm's length transaction.
Right. Mm-hmm.
That was the real driver. They didn't want two partners buying and selling to each other to bring capital in. So that was always SBA's stance. So it's really kind of confusing to tell us to do a 180 on that right now. And you can understand probably the lenders in the country are anti that right off the bat, just because, like I said. So are they using that again to hold against us, or I don't know. But that's always been the philosophy behind it.
I think the SBA has to, that's part of their clarification. I think that's part of, because that's so confusing. I mean, you talk to one lender and they're like, oh yeah, it means they can stay forever. Another lender's like, no, they have to leave. It's 100% buyout. So we don't know because it wasn't fully, completely addressed in the SBA SOPs. So I don't know. I think, the other thing too is they don't want the seller staying there if the seller's not guaranteeing, and the seller is a key employee and the seller's making still decisions on the direction of the company when they're not our borrower, they're not our guarantor. And, so I think when the clarification comes back, it's going to be, they have to leave after 12 months unless they're part of the ownership. And if they're part of the ownership, they got to be guaranteeing if the 6-month look back justifies it.
Yeah, I think too, also,
Go ahead, Tammy,
I'm sorry, Tim.
No,
I think there's also to Steve's point, their thought around an additional benefit that the buyer or the seller is going to get compensation wise. So that is also something in their head. I think it's more minor than your point, Lynn and Steve, but I think that's also something that comes into play, that they think that the seller is going to gain additional monetary benefit by continuing to be compensated.
Well, and then when the lenders are underwriting right now, our add back is the seller's compensation, right? Yep. So if the seller's going to stay, certainly not going to stay for free for over 12 months. So can you add that back? Well, then you can't. Well, then do you cash flow? Does that's a tough one too when you're doing underwriting.
Yeah, I agree.
And my big concern is always the seller has too much control. If they hold the license or if they have specific knowledge or anything like that, I've seen it too many times where the seller, is insulted because the buyer changed something or added a computer or whatever. And that fallout post-closing is always my biggest concern.
Yeah, I totally agree.
You mentioned the licensing, Steve. That was actually, a lot of rumors on the street was, well, if the seller can stay for longer than 12 months, and be a key employee, maybe they can be the qualifier for the license as well. And, that's out the door as well. A lot of these things we got excited back in May 9th has changed quite a bit. So I guess it is what it is.
That's still ongoing, just so you know. There was a letter by the U.S. House Small Business Committee sent to the SBA demanding all the research and the documentation of where these rules came from, because this is unprecedented in the SBA. What's typically happened in the past is when there were potential rule changes, they floated them out and got lenders' feedback for months and months and months prior to issuing any changes. This time, none of that happened. Everyone on this call was surprised on May 11th.
And Congress was surprised. They didn't get a heads up on any of these changes either.
Yeah, they were jumping up and down. Congress was jumping up and down, right?
Oh, yeah. Well, Patrick Kelly, who presented all of these rules, quit the day after he presented in front of Congress. The next day he quit. So after promising he would expose how these got there and everything, and then he quit. So there's a lot of things going on up there, but these were a surprise to everyone in the SBA world from what I can see.
All right. So what about, I'm hearing that things are going to be less strict. The SBA is going to be less strict on certain things like landlord waivers and life insurance policies and just, the closing being easier in general. Where do you guys see that falling out at now?
I think it comes back to what Steve said before. It's the prudent lending thing. So basically, as I read through the SOP, it's saying, well, you have the ability to be flexible here, but, whatever you do on your conventional side, that's really what you need to do now. Or, you've got the flexibility, but, prudent lending. And so, again, lenders are left up in the air. Now, a landlord waiver, if you don't have a ton of collateral and, you may have $25,000 worth of collateral and your loan is $1 million, $1.2 million, $1.5 million, $2 million, a lender and the landlord won't sign the waiver. You're like, well, what are we going to get anyway from that collateral? Yeah, we're okay with it. However, you got a machine shop that's got, $1.5 million in machinery, and your loan is $2 million, $2.5 million. There's value there in that equipment. The lender's going to want that landlord waiver. So it's going to also come back down to the one, individual loans and how the lenders are going to look at it. Life insurance, same way. If you've got two borrowers, they're both capable of running the business. They're both working in the business. You need life insurance? Well, probably not. If you have one borrower who is a doctor and it's a doctor's office and he uses product, lenders are probably going to get it. So it's going to be back to the lender's choice, lender's decision.
That's one of those rules I have never been against. I never fought the life insurance rule.
No.
I
that's the thing.
I agree.
Yeah.
That, to me, that's not that, that just makes common sense.
Going back to Lynn's point, right, on conventional, they don't typically ask for life insurance. So, marry your conventional. So I hear some lenders saying, no, now we don't know. But, no lender typically asks for life insurance on a loan.
No, and the same as the proving cash injection. Now the rule is, do what you do on the conventional side. I don't know about you, but on the conventional side, I don't think we go as deep as we do on these, proving cash injection.
Right.
So are the lenders going to loosen up on that or not?
Yeah. Well, I think it will be tough too for institutions that don't have conventional loans or do conventional loans because they don't have that guideline, right? So, and there are plenty of, online lending institutions that do SBA loans that don't offer conventional products and they don't have credit policy for conventional loans. So I think, that will be a real challenge and a real struggle for them to, figure out what direction that they're going to go in because, back to your prudent lending, if you don't already have those guidelines set up, where do you start, right? And so I feel for those people.
Well, but then also it makes it an uneven playing field for lenders because you got the fintechs out there that, got in when it was PPP and they just thought it was great and they're staying in and they're doing SBA loans. Well, they might be a little more liberal because they don't have that conventional until they start getting slapped on the hand by SBA.
We're going to get down that fintech rabbit hole in a minute, because that is something I want to touch on, Lynn. I'm glad you brought that up. What about the franchise eligibility register? Is that they were saying that they were going to do away with that and it was going to be left up to the lender? Where's that sitting at right now?
That was removed, shut down. But go ahead, Timmy.
No, I was just going to say, I agree with you. Yeah, that they did shut that down, but there is high indicators that they're going to bring it back.
Okay. And so explain to the audience what we're talking about, if you guys don't mind, about the franchise.
I'm happy to. The franchise registry was an online guide where any lender could go in to check eligibility for any franchise funded by SBA throughout this country. And prior to the registry, and I don't know, you people are young, so you might not remember. We used to have to read.
I remember.
I don't want you to. We used to have to read UFOCs before they were FDDs. But the franchise disclosure document, which you get from a franchise, 125 pages, we used to have a library of them. And we used to update them every single year. I used to call the franchise and say, I need 3 copies. But we used to make the determination for SBA eligibility in-house. Most of my lenders had in-house counsel that would review them, or a counsel firm outside that we would send it to, and they had to make their own determination if every single word in that FDD conforms to SBA rules. If it didn't, you had to have it adjusted or whatever else. So I want to say, I don't know, 15 years ago, they went to an online version that was live, completely current, and it's dictated as the franchise registry. So it takes that entire piece off the lender's desk, and a lender just has to go into the registry and see if they're on it. If they are listed on the franchise registry, they are eligible for SBA financing. If they're not on the registry, they were not eligible. It was cut and dry. It took that burden completely and liability completely off of the lender, and now they're shutting it down. They're saying, well, it's going back to you people. All right.
Wow.
So, lenders aren't prepared for that. The majority of my lenders are saying, we're going to back away from franchises till they figure this out. We all downloaded it on May 11th before it went away just to see. Yeah. We had the most current list. I mean, everybody downloaded it.
What's their thought process in removing that? Why is that a benefit? I mean, I think that protects everybody. It protects the lender and it protects the buyer. And, what was their thought process?
I wonder if it's just a manpower thing. There was a lot, because you would get a franchise that would come in and they're not on the list. So then you have to go to the franchisor and say, you want your borrowers or your franchisees to be able to get SBA loans. You need to go to SBA, submit all this stuff. SBA reviews it, and then they'll say yes, then they'll put you on the registry, or no. And I had one that it took 8 months because, it took the franchisor, they had to get audited statements and submit everything to SBA. They finally got approved. But so I think, I don't know, I haven't been told anything, but I really believe it's just a manpower thing. SBA didn't want to have that on their plate anymore to have to review these things.
I run the other way. Maybe it's the pessimist in me. I'm thinking more lender exposure and liability. Again, I started with the first prudent lending guidelines and I'm always looking at it from a lender's perspective. I don't want to protect my lenders, but I thought that was just it opened the door wide open for more, again, liability on the lender's side, which is horrible.
It does.
Is that the same system that would say how many loans that franchisor had in the last so many years and how many were defaulted on and things like that?
Yeah.
Yep.
So they're now talking about bringing that back, right?
Yeah.
That's the talk. That's the word on the street I'm hearing.
Yeah.
Okay. What about personal liquidity rules and limits removed and things like that? Where are we sitting on that right now for the buyer?
I think they've removed them again. They were gone for a long time. They came back for a short period, and now I think they're gone off the table. So I think there's no more personal liquidity rule, which I'm a big fan of because those are my clients. I work with a lot of high net worth individuals.
Yeah, right now I don't see anything in my notes about that potentially being walked back, but that doesn't mean that they're not going to. But they did eliminate the personal resource test.
All right.
So explain to the audience what we're talking about, and how that affects the buyer and the lender.
I'm happy to feel. Lynn, you want to jump on that?
No, I was going to say, who wants to take it?
Go ahead, Steve.
Ultimately, there are rules in place that say if a borrower is too liquid, they become ineligible for SBA. That's one of the main criteria. It's really too liquid. If they had, I believe it's 1.5 times the loan amount on our larger deals, then they were kicked out of the program or had to inject the difference. And with some of my clients, that could be $1 million. That could be $1 million, God knows. So they became ineligible, which on your larger transactions, $4 or $5 million transaction, you want a higher net worth borrower. You don't want somebody that's scraping together that $300,000 to make the deal happen. So I was always a big fan of and I think that they're more responsible. If they're buying a $4 or $5 million business and they have a level of personal liquidity, guess what? They're a more prudent buyer to me. I think I'd rather back that guy all day long than the guy who's borrowing, $50,000 from his mom. So
Yeah.
I'm kind of happy. This helps a lot of my clients because we work with a lot of high net worth individuals.
Yeah, let's get a high net worth individual in there and lets them leverage their money. And like you said, chances are they're even a more seasoned business owner. So we're in a situation where that's still going to be waived, and we're not worried about the liquidity of the buyer. Correct?
I think they're going to
As long
leave
as they don't rescind it, like she said, anything can be rescinded. It's crazy. They could cross all of this stuff off tomorrow. I do think it's going to stay. I don't know what you guys are as far as thinking that, but
Yeah.
That's one I have not heard any negative feedback on yet. So
I agree.
Okay. So now we're going to go down that rabbit hole. I mean, this is my thinking is like May 9th, the SBA came out. I think it was May 9th. The SBA came out and they said, we're going to make all these changes, make all these rules. And they were making it more aggressive or more able for people to do SBA loans, kind of like they wanted to spur the SBA loan program. But at the same time, the federal government's been trying to slow down our economy because it's been so hot, by increasing interest rates. And it kind of feels like they're both kind of at odds with each other in what they were trying to accomplish. Now, obviously, they've walked back a lot of these things they talked about, back in May 9th. But, like, why? Why is there that disconnect there? Do you guys have any, and maybe it's not a factual thing, more of an opinion thing, and that's okay. I'm curious.
Mine is an opinion thing. And I just think one hand doesn't know what the other hand's doing and they don't coordinate. So, the Fed feels their job is to, get inflation under control, and they're going to make their rules to do that. The SBA feels their job is to get as much money out to, the borrowers that need it, business owners that need it. And so they're loosening their rules so that, they can get more money out there. And so I just think it's not a coordination. I don't think either department, either side is coordinating with the other. That's my view.
Anybody else?
Well, I did watch the congressional hearings, and their motivation as they stood at the podium was to help the underserved and lower income communities with startup transactions. And the fintechs, what they focused on was $25,000 to $100,000 loans that they could give out within days.
Explain what a fintech is. Well, explain what fintech is before you go on.
A completely algorithm-driven loan application. It's and I don't want to even name names as examples, but they're completely online firms that it's fill out a form online and get declined or approved right there on the spot, or I think within hours. But it is entirely algorithm-driven. You put in the correct answers, you get the money. And that's an issue because what I've done homework on is they said even if you get declined at one, go to the next one and fill it out differently. But it's from what I saw at the podium was to help the low-served communities start businesses. So that's where the fintechs are not going to be dealing with a $3 million transaction or a $4 million transaction. I don't think. I mean, maybe that's a possibility, but it looked like they were all about those small loans that they could give out within days. Now, going back to what we saw in PPP, the fintechs caused all the defaults. So that's the biggest concern here. Is
Yeah, they had the most
defaults went through
defaults.
the
The
roof.
fintech was having tons of problems.
It's all
Fraud
average.
was fraud too. Fraud and
Right.
defaults.
Yeah, exactly right. You answered the question wrong, you got declined, you go back, change your answer. So that's where the biggest concern was. This was with no input, like I said, from the actual lenders. So fintechs are completely online, algorithm-driven firms that will just be handing out money in the future if this passes. So that's the biggest concern, I think, for me. What's going to happen is someone's going to have to make up for those defaults in the future. Whether it's going to be, there's only two places they can get it from, is either the taxpayers or our performing loans, which is increasing our SBA fees. Now, going back to one of the other things that we mentioned, all right, you said this, Jim, you said you're thinking that they put these rules out to become more aggressive and get more money out to businesses and things like that. Well, in the past, they have done that many times through our careers, and this is not the way they do it. The way they did it in the past was waiving SBA guarantee fees. What was some of the other things? I don't remember if they lowered interest rates or they put out special programs that increased SBA to the correct without changing the procedural notices and the guidelines. So, if they really wanted to, increase our guarantee, waive SBA fees. Those are avenues to increase our portfolios, not by putting it out to just anyone who asks for money. And that's where the big disconnect, I think, comes from on my side.
Well, and Sue, Lynn, Steve, I don't know what your take on this is, but they have talked about raising the exposure cap for a while. That would have been amazing if they would have raised the cap, even if it was $1 or $2 million. Then that way you open up a whole nother level of folks that can participate in the program. I mean, I know those would be higher SBA fees, obviously, but they've talked about raising that cap for a while. And the last time they raised it from, what was it, 2 million to 5 million?
3.5, I think.
Yeah. How long ago was that?
long time ago.
Yeah.
Right. They could have gone about this a bunch. If they were looking to truly help small businesses, there are a lot of other methods and avenues they could have taken. So that's why, I may sound, like I said, pessimistic a little and a little concerning, but these are the things that pop out of these rules to me.
Mm-hmm.
So it is really
broker,
kind of a head scratcher on why the SBA felt they needed to loosen some of these SOP requirements when, like you said, the economy is, you're raising interest rates. So we've got borrowers that borrowed money when prime was like almost nothing.
I know.
And now their payments are gone up $10,000 a month practically.
I know.
It's killing them. I mean, we get calls all the time for our servicing department. Just, borrowers are like, what can you do? What can you do? There's not a lot we can do.
Yep. Yeah, I hear the same thing. Right. I'm working on larger transactions. Well, those are the ones that get hit the worst.
Yeah.
You're right. They could be $10,000 a month higher. It is crazy. So there were a lot of other ways they could have addressed this if they were really looking to help small business. Like I said, maybe that's where my pessimism comes in, but that's just me.
You were talking about the fintech and these $50,000, $100,000 loans, making them happen quicker and making it more available, which sounds nice in theory, but and as a broker, as a business broker, from my point of view, it's awesome when they get really aggressive with SBA loans, and it's good for the buyers and it's good for the sellers, but in the long run, is it really good for us in the long run, and is it really good for our country in the long run? I mean, you look at they were giving out money in the 2007, 2006 to the houses, and that caused all kinds of problems. Look what happened to Japan in the 90s when those banks in Japan were giving money out left and right to their citizens. I mean, it catches up to you. It's nice for a short run, but it's not good for any of us long term. I don't know.
Right. Not at all.
That's why I say. Go ahead.
I was going to say, we certainly want the SBA program to stick around for a long time. We certainly don't need a rash of defaults, and if that happens, we'll be in a bit of a predicament.
And like I said, if they wanted to really stimulate the program, there were so many other better ways to do it that didn't change. Guess what? If you waive an SBA guarantee fee, the chance of default is not changing on that transaction. But if you give it to them with 2% down or 0% down, guess what? Your default number just changed. So that's really where the big disconnect comes in.
Well, guys, do you have anything else you guys want to add today to the business brokers out there? Anything else that you think that they should be aware of?
Just
I think
stay
the important
tuned.
thing today, I'm sorry, but this is important, is getting together with your BDO, your experienced BDO, not someone who's been in the industry 3 months or 6 months or anything like that. You know, Lynn, Tammy have been around for a long time. They know how to navigate these things and work through these rules, which ones make sense and don't. They're going to be your avenue for the most aggressive level, I think. So it's really getting back with your lender and talking to your experienced people and understanding where they're at, which is what I'm doing as a firm. We're talking to all our lenders to understand where they're sitting right now. But don't fall for that email you got that said you can do 100% financing on a business acquisition and talk to somebody who just threw out an email. That's key.
That's great,
I
Steve.
totally agree, Steve. I think that communication is going to be key over the next 6 months. If you think it's too good to be true, ask somebody else, because odds are that maybe that it's not that somebody's trying to be deceitful. Maybe they just don't have the right information. And so it doesn't ever hurt to get a second opinion. Do it at a doctor's office if you didn't like what they said. So I would encourage people to just keep communicating, asking questions, using any and all of us as just a resource. Any of us are happy to answer an email, pick up a phone, answer a text message about a question, about the rules, about the guidelines, about what we're doing at our institutions as well, because that's going to differ from bank to bank to bank too. I don't think it will differ a lot, but I think there will be some differences. And so that's what I think we are all here for, is to support you all as brokers, your customers, your buyers, your sellers, and just, keep all of the information flowing so that it helps all of you at the end.
That's fantastic.
Yeah, totally agree.
I got to tell you, fellow business brokers out there, when I wanted to do this webinar, I went right to Steve Mariani, Lynn Singletary, Tammy Teese. They're 3 of the best lenders that I know out there. They're fantastic. They've been doing it for a long time. They're extremely knowledgeable, and they're very humble. And, like they said, if you guys got any questions, reach out to them, give them a call, send them an email, and reach out to them. They're wonderful people, and they're the best. And right now, with all these changes that we're experiencing, this is the time, like Steve said, to reach out to the BDOs that have the experience, and because we're in odd times right now, and I think we're going to be in odd times for the foreseeable future. But business brokers, I'm really glad you joined us. Thank you for watching the show today. And please, if you haven't already done it, do me a favor, subscribe to the channel, like the program. That way you can make sure you get more good information in the future. And until next time, take care.